Welcome to the Wealthfinity channel. Today, we're diving into the topic of risk tolerance in management. Risk tolerance refers to a person or organization's ability to accept uncertainty and potential loss in pursuit of a desired outcome. Understanding risk tolerance is crucial for making informed investment and business decisions. Join us as we explore the different levels of risk tolerance and how they can impact financial planning and management. Risk tolerance is a term used to describe an individual's willingness to accept financial risk. In other words, it's the amount of uncertainty or potential loss that a person is willing to tolerate in pursuit of a financial gain. It is a crucial factor to consider when making investment decisions and determining an appropriate investment strategy. In general, people can be classified as either risk-averse, risk-neutral, or risk-seeking. Risk-averse individuals are typically more conservative and prefer low-risk investments, such as bonds and cash. They are less likely to take on the risk of investing in stocks, which can have higher returns but also come with a higher level of uncertainty. Risk-neutral individuals are more balanced in their approach to risk, and are willing to consider a variety of different investment options. They may invest in a mix of low-risk and high-risk assets, depending on their overall financial goals and risk tolerance. When it comes to investing, risk tolerance is an important factor to consider. Some investors are comfortable with a high level of risk and are willing to invest in more volatile assets, such as stocks, in order to potentially earn a higher return. Other investors prefer a lower level of risk and may choose to invest in more conservative assets, such as bonds or cash, which generally have a lower potential for growth but also a lower potential for loss. Risk tolerance is a fundamental concept in investing and personal finance. It refers to an individual's willingness to take on financial risk in pursuit of a potential reward. Understanding and defining your own risk tolerance is crucial for making informed decisions about how to allocate your assets and manage your money. It's important to consult a financial advisor to help you assess your risk tolerance and develop an investment strategy that aligns with your goals and risk tolerance. They can also help you evaluate the different types of investments that may be suitable for you, as well as help you manage your portfolio over time. There are many different ways to measure risk tolerance, but one common method is to use a questionnaire or survey that asks about an individual's investment goals, experience with investing, and their attitude towards risk. Factors such as age, income, and overall financial situation can also play a role in determining risk tolerance. When determining your risk tolerance, it's important to consider your short-term and long-term financial goals, as well as your overall risk tolerance. It's also important to remember that risk and return are directly related, meaning that the higher the risk, the higher the potential return. However, it's also important to consider your ability to handle the potential loss that comes with higher risk investments. One benefit of understanding your risk tolerance is that it can help you make more informed decisions about how to invest your money. For example, if you have a low risk tolerance, you may want to allocate a larger portion of your portfolio to more conservative investments such as bonds, rather than riskier investments such as stocks. On the other hand, if you have a high risk tolerance, you may be more comfortable with a greater allocation to stocks and other higher risk investments. Another benefit of understanding your risk tolerance is that it can help you manage your expectations about the potential returns on your investments. For example, if you have a low risk tolerance, you may need to accept lower potential returns in order to achieve a level of risk that is comfortable for you. Conversely, if you have a high risk tolerance, you may be willing to accept higher potential returns in exchange for taking on more risk. It's important to note that risk tolerance can change over time, and it's a good idea to regularly reassess your risk tolerance as your financial situation and goals change. Additionally, it's also important to remember that risk tolerance isn't a one-time assessment and should be updated as your personal and financial situation changes. Risk-seeking individuals, on the other hand, are more aggressive and willing to take on higher levels of risk in pursuit of higher returns. They may invest heavily in stocks, options, and other high-risk investments. It's important to note that everyone's risk tolerance is different and can change over time based on personal circumstances. Factors such as age, income, and overall financial situation can all affect an individual's risk tolerance. Risk tolerance is a crucial concept in personal finance and investing. Understanding your own risk tolerance can help you make more informed decisions about how to invest your money and manage your expectations about potential returns. Regularly reassessing your risk tolerance as your financial situation and goals change is also important. With this understanding, you can make investment decisions that align with your personal risk appetite, which can help you achieve your financial goals and build wealth over time. It's important to understand your level of risk tolerance, to make investment decisions that align with your short-term and long-term financial goals and overall financial situation. It's always a good idea to consult with a financial advisor for guidance when making investment decisions. In conclusion, risk tolerance is an important concept in management and finance. It refers to a person or organization's willingness to accept uncertainty and potential loss in pursuit of a desired outcome. Understanding and assessing your own risk tolerance can help you make better investment and business decisions. It's crucial to take into account your own risk tolerance when creating a financial plan. It's important to remember that risk and reward are closely linked, so a higher tolerance for risk may lead to higher potential returns. On the other hand, a lower tolerance for risk may result in more conservative investments with lower potential returns. It's essential to find a balance that aligns with your goals and comfort level. Thank you for watching, and we hope you found this video informative.